Stocks fading again as the day wears on here. Wall Street has seen this pattern before, 2 steps forward on developments in the fight against the coronavirus, and then 1 step back on a reopening rollback. So can investors break this cycle? With us now is Chris Zaccarelli, Chief Investment Officer of the Independent Advisor Alliance, and Margie Patel, Senior Portfolio Manager of Wells Fargo Asset Management. Margie, what do you think is going to happen here as we move through the summer? Are we in a trading range or and sort of captive to the headlines, or what?
Well, really, since the end of May, we have been in a flattish trading range, market really not going anywhere. And I think the real keynote will be, as we see earnings, 3/4 of companies should report negative earnings. But I think more important, their outlook. Have we hit the bottom with a V? Companies are then looking for advancing activity, or are companies still not having found a bottom yet to move forward in the economy? And I think that'll be the real keynote, what to look for in companies' earnings. I personally think so much negativity, the surprises will be on the upside. The market will get through this quarterly announcements and move up for the rest of the year.
Chris, you make the point that the Federal Reserve and the federal government have been the backstop for this market. What if that doesn't persist? What if there isn't follow-on fiscal stimulus? I think we can pretty much count on the Fed doing whatever it can do to backstop the economy, if not the markets. But how about that?
Well, I agree. I mean, clearly the Fed has had the markets back this entire time. All that liquidity that they've injected into the system, let's call it somewhere between $4 and $6 trillion when you couple that with the fiscal stimulus that the U.S. government has put in there. So I think the Fed has made a commitment to stay behind the market in order to keep things calm and orderly. However, it's really the federal government at this point that can be the marginal difference in terms of supporting the economy. We saw with all the bank earnings yesterday, and to a lesser extent this morning, there's a lot of loan loss provisions out there. So I think if you listen to what the CEOs are saying at some of the larger banks, they are mentioning some caution on going forward. And so I do believe it's important, in order to support those consumers, you are going to have to continue to see continued stimulus. At the end of the year, the fiscal stimulus in terms of unemployment benefits is scheduled to run out. I do think they'll come to some type of compromise. I don't think politicians on either side of the aisle want the economy to go down right before the election. So I think there's bipartisan support for some type of package, but it's just a question of how they make those compromises and what happens. In the absence of that stimulus, I do think the market is a little bit at risk.
Let's get to some specific sectors that you both like or would loathe. Margie, starting with you, the banks had pretty good reports generally today. Do you like financials, or would you be putting fresh money in other sectors of the market or in individual names that you want to mention?
We've been avoiding the financial sector for quite some time. They haven't gotten a lift from net interest margins or from low rates. We haven't seen loans really increase. Losses are going up. We think it's a very uninteresting sector. So we're looking at other sectors. Technology, healthcare are still the 2 big sectors that we think have the most opportunity.
All right. And Chris, why don't you dance us through here? You list financials as one of the sectors you do like, but you also like healthcare and select portions of emerging markets. So give me your profile here.
Sure. And again, to be clear, we're very selective. We're looking within specific parts of the financial services industry. We would not be broad buyers of the index in and of itself. There's certain best-of-class names that are still out there, and they're operating very well. In addition, you can look in other areas besides the large banks in terms of the exchanges and look at for increased volatility going forward. In emerging markets, again, you want to be selective. You wouldn't want to just buy a broad index of emerging markets. You want to look within certain companies within China, within India, that we believe will provide some of those growth opportunities that you've already seen come to realization, full valuation in the United States. But if you look overseas, those same growth opportunities are there, just at a lower valuation. And we think if you are going to look internationally, you want to be selective. And now may be a good time in the middle of the year to look outside the U.S. instead of just looking inside the U.S.
It's a really good point there. When we speak of financials or we speak of healthcare, it's a very broad sector. There are financials, and then there are certain subsectors there, which is your point, and in healthcare the same. You can go into the pharmaceuticals, the device makers, and so on and so forth, the hospital companies, what have you. All right, folks, thank you very much. Chris, Margie, we appreciate it.